Let's start our discussion on the value of recurring revenue with a case study comparing IT consulting or IT service companies to SaaS companies. In this video, I'm going to present financial data for 6 large IT consulting companies and 5 publicly listed SaaS companies. This data is from 2018-19, well before the COVID-19 pandemic. So it presents a picture that was not tainted by the turmoil caused in the financial markets by the pandemic, the corresponding stimulus measures, or the stay-at-home mandates. The 6 IT consulting companies are at the top of this table: TCS, Infosys, Wipro, Accenture, HCL, and Cognizant. The 5 SaaS companies are at the bottom of this table: Salesforce, Workday, Dropbox, Zoom, and Slack. Let's start with revenue. In 2018-19, amongst the IT consulting companies, Accenture made $43 billion in annual revenue, while Tata Consultancy Services, TCS, made almost $22 billion. In the same period, amongst the SaaS companies, Salesforce made $13 billion in revenue, while Zoom and Slack made only about $600 million. Next, looking at net profit, which is also called net income. Note that all IT consulting companies were massively profitable, whereas 3 of the 5 SaaS companies made losses. Both Accenture and TCS made about $4.5 billion in net profit, whereas Salesforce made almost $1 billion in net profit. In the same period, Workday, Dropbox, and Slack lost almost $500 million, while Zoom broke even. If you look at the ratio of net income to revenue, which is called net margin, all IT consulting companies had comfortable net margins between 11 and 21%. But the SaaS companies had terrible net margins. Slack's was minus 90.6%, which means that it lost 90 cents for every $1 in revenue that it made. Next, let's compare the total valuation of these companies, also called market capitalization or market cap. Accenture was the highest valued IT consulting company at $129 billion, while HCL was the smallest of the pack at $11 billion. Looking at the valuations of the SaaS companies, Salesforce was worth $118 billion, Dropbox was worth $7.3 billion, and Slack was valued at $8.3 billion by the public market investors. If you divide these market caps by each company's revenue, you get the revenue multiples. You will notice that the IT consulting companies had small revenue multiples between 1.2 and 5. But the SaaS companies had much richer valuations with much larger revenue multiples, starting with 5.3 for Dropbox and going as high as 31.3 for Zoom. This means that each dollar of revenue that Zoom brought in got it $31 in valuation, whereas the same dollar of revenue brought in by HCL got it only $1.20 in valuation. Why do you think this is? Why are SaaS companies getting much richer valuations than IT consulting companies? Think about it, I'll answer soon. Next, let's divide the market cap of each company by its net income to get what is called the PE ratio. This will help us see how public market investors value the profits generated by IT consulting companies versus the profits generated by SaaS companies. These numbers are even starker. Investors valued IT consulting companies between 7 times to 27 times profits. But the profits made by SaaS companies were valued way higher. Salesforce was valued at 111 times its profits, while Zoom was valued at 848 times its profits. And the ratios for Workday, Dropbox, and Slack did not even make sense because these companies did not make any profit. Moving on to gross margins, which are margins left on revenue after deducting only direct costs, not indirect costs like R&D. Now the picture has strangely reversed. The IT consulting companies made moderate gross margins, around 30 to 40%. But the SaaS companies are all extremely profitable at the gross level, with at least 70% gross margins. Next, let's look at growth. The IT consulting companies were all growing slowly between 5% and 20% annually. But all 5 SaaS companies were growing much faster, with Zoom growing 88% annually and Slack growing 57% annually. Finally, and this is the strangest piece of information, if we look at the amount of investment made into research and development by each of these companies as a percentage of their revenue, the IT consulting companies barely invested about 1% of their revenue into R&D. But 3 of the SaaS companies invested more than half of their revenue into R&D. Zoom invested 72% of its revenue in R&D. What a stark comparison between these two kinds of companies, don't you think? Now, let me ask you this. Why are the revenue multiples and PE ratios of IT consulting companies lesser than those of SaaS companies? There is a humongous difference in these ratios, which points to something structural, something fundamental. Think about it and note your answer somewhere before proceeding. Next, why are the companies with the highest gross margins also making the highest losses? And why do they have the worst net margins? Shouldn't a company with a higher gross margin also have a higher net margin? For example, Slack has the highest gross margin of the pack at 84%, but it has the worst net margin at minus 90.6%. How can this be? Isn't this strange? The companies making the smallest gross margins are eking through positive net margins, but the companies with the largest gross margins are losing all of their gross margins and then some to report net losses. What is going on? Some students point out to me that the SaaS companies in this table are early stage compared to the IT consulting companies that are more mature. So the SaaS companies must be spending a lot of money on marketing and customer acquisition, which would reduce their net margins despite their high gross margins. But compare Salesforce with Cognizant and HCL in this table. All 3 companies were founded in the 1990s. Of these 3, Salesforce has the highest gross margins by far at 74% versus 39% and 32% for the other 2. But despite that, Salesforce has the smallest net margins of the 3. At the scales at which these 3 companies operate, it is tough to sustain the argument that Salesforce is early stage and hence needs to spend more on customer acquisition compared to Cognizant and HCL. Something else is going on. If you can think of other reasons for this anomaly, note your answer somewhere before proceeding. I will give you the answer shortly. Finally, look at the tech R&D spends again. Why are the least profitable companies spending the most on tech R&D, while the companies with the most profit are completely skimping on R&D? Shouldn't the most profitable companies spend the most on R&D as well? For example, TCS makes almost 21% net profit margins and spends just 1% of its revenue on R&D, whereas Slack, which loses the most money, invests 72% of its revenue in R&D. Why? What is going on? Some students answer that the SaaS companies here are in the growth stage, so they must invest in innovation and R&D, which more mature companies don't need to. But the IT consulting companies in this table are in a much more competitive market. They regularly compete with each other and with thousands of other companies providing similar services. Whereas the SaaS companies have fairly unique products with maybe a dozen or even fewer competitors. So if anyone needs innovation to build differentiation, it's the IT consulting companies, not the SaaS companies. Then why are they investing such a measly amount in R&D? Some students think that this is because of size. The IT consulting companies have larger revenues, so even a smaller percentage makes a larger total spend. Again, if you compare Salesforce, HCL and Infosys, you will see that they have similar revenues. But Salesforce invests 14% of its revenue in R&D, whereas the other two invest just about 1%. So it can't be about size. It has to be something fundamental. Some students also take a more cynical view that IT consulting companies are profitable only because they are not spending on R&D. If they spend on R&D, they would not be profitable, like SaaS companies. Some others also apply similar cynicism to the loss-making SaaS companies and ask, if they are making losses, why are they spending so much on R&D? Shouldn't they focus on becoming profitable first? So it's quite a mind bender. Profitable companies that don't invest in R&D and loss-making companies that seem to over-invest in R&D. What's your view? What's going on here? If you have formed a different view, note your answer somewhere before proceeding. I will answer questions 2 and 3 now and will tackle question 1 next. So, why do the companies with the highest gross margins have the lowest net margins? If you have taken the first course of this specialization, the answer should be intuitive for you. It is because net profit is a management choice. There is nothing fundamental about net profit. Management may choose to spend money on growth, R&D, etc. and end up reducing the company's profit. Or they may choose not to spend money on such things, declare profits and pay out dividends. Management may choose to raise capital and use it, which would result in an accounting loss, or to not raise capital and declare a profit. If it sounds strange to you that raising capital would lead to an accounting loss, please watch my video on cash accounting back from course 1, Belief Systems. You can find it if you tap on the banner at the top right corner. The takeaway here is that profit and loss are management choices. So gross margin and net margin are not necessarily related. A company with great gross margins may choose to invest heavily in R&D because it sees great growth opportunities ahead, and this investment will reduce its net margin and may even result in a loss. So why are the least profitable companies spending the most on tech R&D? Because R&D spend is only a function of two things: the availability of growth opportunities for the company and the availability of capital. So imagine you are the CEO of Zoom. You have all these wonderful growth opportunities in front of you that you can invest in, and your investors are also willing to fund you further. Doesn't it make sense to raise capital and invest in growth opportunities, even if such an investment will appear as an accounting loss on your financial statements? What else would you do? Not exploit growth opportunities to avoid reporting an accounting loss? Would that be good for the company? And why are IT consulting companies not investing as much in tech R&D? It is because they do not have great growth opportunities available to them, unlike the public SaaS companies that we discussed. Now, even though net margin is a management choice, note that gross margin is not a choice. Gross margin is a crucial feature of a business. Gross margin depends on the defensibility of a business against competition. We will discuss this in greater detail a couple of videos later. For now, just note that all IT consulting companies have similar gross margins in the 30 to 40% range, and all SaaS companies have similar gross margins in the 70 to 80% range. Finally, returning to question 1, why are the revenue multiples and PE ratios of the SaaS companies in this table much higher than the IT consulting companies? There are 3 reasons for this. The first is growth. The SaaS companies in this table are growing much faster than the IT consulting companies, which gets them better valuation multiples. Secondly, gross margins. SaaS companies have higher gross margins, which is a signal that their business models are more defensible, which again gets them higher valuation multiples. And thirdly, most of the SaaS companies' revenue is recurring in nature, and investors value recurring revenue more than one-time revenue. Why is this the case? I'll answer this in the next video.
Hey there, I'm KJ Saxena, founder of Relentless VC. The video you just watched is part of the Venture Capital and Entrepreneurship Specialization, which is available absolutely for free on relentless.ventures. Go check it out. If you're a tech startup founder and want to raise money from us, you should apply on our website. Lastly, if you like this video, do subscribe and share it with your friends.